Hi, this is Alan House. I'm a senior analyst here at Value Line. I'm joined today by another senior analyst, Nathaniel Ekman. Today we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and answer any questions you may have. Please note that this presentation will be available on our website, www.valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are posted there as well. Before we get into the presentation, for those joining us for the first time, I want to provide a brief overview of who we are here at Value Line. We're a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent, and unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity or security. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The Federal Reserve has maintained its hawkish monetary policy stance. This was evident in the release of the minutes from the July Federal Open Market Committee meeting. The central bank noted upside risk of inflation that could require additional monetary tightening. Fed leaders also said that disinflation in core prices, which exclude the more volatile food and energy components, was still not significant enough for the lead bank to think its job of promoting stable prices is complete. The minutes indicated that more below-ground growth is needed to bring supply and demand into better balance and ultimately push prices lower. The second quarter gross domestic product advanced reading of 2.4%, and the recent gains in retail sales and industrial production suggest this objective remains elusive. The recent struggles of fixed income securities have given the market some indigestion. Treasury market yields have spiked in recent weeks, as reflected by the yield on the benchmark 10-year Treasury note hitting its highest level since 2007. This development is putting pressure on stocks, particularly those of the higher growth but often less profitable companies. The elevated yields are the product of a number of factors, including the solid June quarter GDP figure, the massive selling of Treasury notes by the Fed following the temporary resolution of the debt ceiling, and the downgrade of U.S. issued debt by a major credit ratings agency on August the 1st. Americans are still spending. Consumption activity has been the backbone of GDP expansion, but should the recent trend be worrisome? True, the tight labor market has given consumers more confidence, but the recent spending has come at the expense of shrinking savings accounts and sharp increases in credit card transactions. Higher prices due to inflation are forcing many families to turn to the credit market to make ends meet. Credit balances topped the $1 trillion mark in the second quarter. These bills will eventually come due with substantial interest, and when combined with the resumption of student loan repayments in October, may hurt future spending. In conclusion, the market is faced with a lot of uncertainty at a time of the year that has certainly not been a great period for equities. Given this environment, we recommend maintaining a well-diversified portfolio primarily consisting of high-quality stocks and cash. On that note, Value Line is providing a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line provides a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report. Reports that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's www.valueline.com. We will now show you how to access it. Once signed in, head to the dashboard where Nathaniel is already located. This is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention the case for individual stocks is quite strong over broad index funds. Now let's move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields. I should also mention that another 100 or so fields are available, but it requires a higher level of subscription. If this interests you, please call 1-800-VALUE-LINE. The economic backdrop remains uncertain. Inflation is still above the Fed's target rate, interest rates remain elevated, and the possibility of a stateside recession is looming on the horizon. With today's candidates, we want to emphasize a good balance of financial stability and upside potential in the intermediate term. We'll start the screening process by looking at the safety rank under the Ranks and Ratings tab. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is ranged at an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus on stocks with a safety rank of 3 or better. By applying this criterion, we've trimmed our list of potential candidates down to from 5,700 to 2,045. Now we're going to look at timeless. Timeless is one of our tried and true measures. It's a proprietary value line metric that evaluates a stock's projected price performance in the coming 6 to 12 months. It's a straightforward scale from 1 to 5, with 1 being the highest. Today, we want to focus on stocks we believe will outperform the market. So we're looking at stocks ranked 2 or better. We're going to apply that screen, and now we are down to 319 companies. We're staying in the ranks and ratings section, whereas timeless attempts to quantify this outlook for the equity in the next 6 to 12 months, our technical score is focused on the coming 3 to 6 months. We're looking at stocks with a technical score of 3 or better. After applying that screen, we are down to 271 names. Expanding our time frame from the short term to the intermediate term, we're looking at stocks with 18-month appreciation potential of 25% or better. By applying this screen, we've narrowed the list down to 52 candidates. Finally, we will now look through a longer-term lens and focus on 5-year earnings growth potential. We're going to focus on companies with 5 years earnings growth of at least 20%. After applying this screen, we are down to our final 8 companies. You can make a strong argument for any of our remaining candidates, and investors interested in adding new positions should consider them. However, only one stock can be today's one stock to buy right now. And after consulting with a number of our senior analysts, we prefer and recommend Deere & Company, ticker DE. Before I click on Deere, please note that screens can be saved and revisited by utilizing the Created Save Screen button at the top. Let's take a look at our last full-page report on Deere. As you can see in the statistical array, or the center of the report that includes the financial data, Deere's revenue and earnings per share have advanced at a robust clip over the past 5 years. The strength has carried over into fiscal 2023, which ends October 31st, with revenues and net income increasing 30% and 36% respectively on a year-over-year basis in the second quarter. On the manufacturing side, higher prices and improved shipments volumes formed a potent combination. This helped to offset relatively sluggish conditions in the financial services business. Deere shares have lost some ground since the time of our early August review. This is the case despite a positive earnings outlook for both this year and next. While bottom line growth is only likely to be modest next year, this is on the heels of a likely very strong fiscal 2023. The recent dip in share price may present a good buying opportunity. Taking a look at some of the quantitative metrics, the stock has solid marks across the board, including top marks for safety of 2 and financial strength, A++, as well as good scores for price stability, price growth persistence, and earnings predictability. Upside potential in the 18-month time frame is above average as well. Deere is poised for strong results in the next 2 years and beyond, and the stock can form one of the building blocks of a well-diversified portfolio. It is today's one stock to buy right now. We will now tackle your questions. Please know that we typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation. I have a question here from Joe. It says, what's the difference between a safety ranking of 2 and 3? Well, the safety distribution, I guess, of the stocks in our universe is a bell curve with more rated 3 and less rated 1, 2, 4, and 5. So if you want to look at it as a bell curve, the vertical pinnacle would be stocks rated 3 for safety. There's more stocks rated 3 than anything else. So in regard to this particular question, there are fewer stocks ranked 2, but also, you know, there tend to be less volatile than stocks ranked 3. There's no, you know, it's just the way they're grouped. You know what I mean? There's we look at financial strength along with some of the other safety metrics we use. So a stock with a safety rank of 2 would, in theory, be less volatile than a stock with a safety rank of 3. And another question from the same person, Joe, says, how much does total debt level determine safety ranking? Which is another excellent question. This depends on the industry. There are some industries with higher barriers to entry than others, like aerospace and defense, for instance, cruise ship operators. You know, companies like that are probably going to have much higher debt levels. So that has to be taken into consideration when applying the safety rank. Where the other ones, maybe toy manufacturers, or, you know, there's others that have much lower, you know, fixed costs, so to speak. So they're you know, so basically it goes by the industry that the company is in. That's definitely taken into consideration. So there's no standard answer to this question. You know, you know, 35% debt to equity has always been, from my understanding, kind of like an average debt to equity ratio, but that varies by industry, you know. So, but I use that as a benchmark. But again, it depends on the industry. So our safety rank does take into consideration how the debt level is compared to other stocks within the industry, and even, you know, companies like amusement park operators who are heavily leveraged. Sometimes some companies are a lot more heavily leveraged than others and unable to satisfy that debt, and that's another, you know, factor we look at too. How you know, solvent are they to satisfy those debt obligations? I mean, a company can have 75% debt, but if they're leveraging that debt well, you know, it definitely, you know, augurs well for the company's ability to satisfy that. Thank you.
Great answer, Alan. I have here a question from Raju asking, in our calculations for a company's book value, does that include both tangible and intangible assets? And if so, is there a way to figure out what percentage of that is intangible from our company reports? And the answer is that if that's information you want to know, you'll want to look in the footnotes on the page for the company. Like if we look here at this page, if we look at book value here in the array, we can see there's a footnote D attached to that. And then if we scroll down to the footnotes, we will see that that specifies that yes, that value does include intangibles, and then it gives what the value for that was at the end of fiscal 2022 for that company, both in a total value in millions of dollars and as a value per share. And you will see that again and again on pages in the survey. That specific footnote is very common. And so, yes, we do give that information.
Okay, thank you, Nate. I see another good question here regarding the timeliness rank versus the 18-month appreciation potential. And our screener brought out both of these factors. And several years ago, Value Line introduced the 18-month appreciation potential, realizing that there were investors, you know, there were shorter-term investors looking at a 6 to 12-month window, and there are also investors looking, you know, for 3 to 5 year returns or beyond, you know. And now there's also investors with like an 18-month horizon. Maybe they just want to they want to hold it, until their child, goes to college or what have you. They're just looking to maximize the returns over the next year and a half or so. So we formulated the 18-month return potential. So that's geared towards people with an intermediate term investment horizon, and it's a good liaison between the timeliness rank and the 3 to 5 year appreciation potential. And the technical rank, to piggyback off that, the technical rank's even a shorter, as I noted in the presentation. The technical rank's an even shorter factor that looks at the forthcoming 3 to 6 months. So we feel like we have all the bases covered between those four factors. Thanks.
All right. I have a question here from one Segareda asking, what are ways I can educate myself on the stock market? As mentioned during our main presentation, on our website there is an investment education section that you can access in the sidebar, and that has information both on investment in general and in the specific on how to read our reports and what goes into those reports, and sort of some of the things that we consider in putting together these reports. Beyond that, and this is getting a bit into how I personally think about companies and investment, the best thing that you can do for yourself is to remember that the stock market, it is its own thing, but it takes place in, the wider context of everything else. And so the best thing you can do as an investor is to be widely read and current on what's going on in the world, especially with regards to things that are having a big effect on the market, but are not necessarily very well understood. Like right now, that would be artificial intelligence. A lot of value is being driven by that. Very many people misunderstand what it means. And so if you want to understand the stock market and you want to do well in the stock market, the best thing you can do for yourself is to understand those forces that are currently affecting the stock market better than other people do. All right.
Thank you, Nate. I just found another question from Michael. He said, is the earnings predictability rating a good indicator of the confidence in the 3 to 5 year price range? I would say, it is a factor in that, but I would say, I guess it's a multi-factor. It's, the higher the earnings predictability, in theory, the higher the price stability of the stock should be. They don't always go hand in hand, but they generally do. In most cases, they're right around the same ballpark. So if a company has pretty highly predictable earnings and the stock price stability should be relatively high, we should have increased confidence in the 3 to 5 year price range. So I would say that, the higher those factors are, the more confident we are in the 3 to 5 year price range. Of course, like Nathaniel alluded to, there's many factors out there beyond, the stock market's control and that can affect these stocks and affect the whole stock market in general, interest rates and, AI and everything like that. So, we just try to, put all these factors together. We do our best to to formulate a 3 to 5 year target price range. And, as I noted, the higher those variables are, the more confident we are in our price range. Thanks.
Mm-hmm. Are you seeing any other questions here, Alan?
Not at the moment. Well, thank you all for joining us. I'll now hand it over to DJ.